Hello, everybody. Welcome to our Facebook Live event. My name is Ida Celli, and I'm here with my colleague, Jerry Vidaratas. Hi, Jerry. How are you?
How's it going, Ida? How's everything?
Pretty good. Pretty good. You?
Pretty good. Pretty good. So, we're still at home, right? Safe and sound. But thankfully, we're here to do another Facebook Live and answer everybody's questions. So let's see how we could, start. Hopefully, everybody starts joining on, and we could start answering some questions.
Exactly. So, anything you would like to remind our viewers?
Well, I just remember that
tax deadline.
Yeah, I mean, yeah, it was. You took literally the words right out of my mouth. Actually, you literally you went right into my head. You just took it right out of there. So remember, the deadline is April 30th, right? Nothing changes. Okay, so nothing changes as far as the deadline. Okay, so the deadline is April 30th. But the good news, so the only extension the government has done is basically an interest holiday, right, for anybody who's received any COVID-related benefits, such as, the CERB or the CRB or other programs and such, and they owe money on their tax return. Then just remember that in that case, you could pay your amount owing until April 30th of the following year, right? Until April 30th of 2022. So you have an interest holiday, so the government's not going to charge you any interest. But as far as the deadline of the return, it is still April 30th of this year. And if you don't file, there are penalties that are involved. Okay, so file your return. Even if you owe money, remember that your debt doesn't disappear. Okay, if you owe money to the government, your debt's not going to disappear by filing your tax return late. Okay, and on top of it, you're adding a penalty to it as well. So file your tax return on time and wait to pay your amount until you have the money. Okay, so you could wait because there's an interest holiday. You could wait until April 30th of next year.
Okay, and what's the importance of filing your return even if you have a balance owing, whether it's big or small?
The importance is, number one, there's no penalties involved, right? Because a penalty and interest is two different things. Penalty is that you're filing your tax return late. Okay, that's essentially what that is. You're filing your tax return late, and the government charges you a 5% penalty on your amount owing right off the bat, and 1% for every month that you're late. That there's no holiday for that. Okay, that's number one. Number two, if you're receiving benefits, for example, a GST credit, Canada Child Benefit, if you want to get these if you want to get the new new yearly benefits on time, you need to file your tax return on time as well, because they're based on your net income. And the only way your government knows your net income is by filing a tax return. So it's really important to file on time.
All right. So we have a few questions here. So why don't we start?
Sure.
So Farida.
All right. So now we can display the questions, which is awesome.
Yes. Could you please give a step-by-step instructions on where to find the flat rate work from home expense claim section on UFile?
Okay, perfect. So let's do that. So Ida, unfortunately, I'll have to hide you for a couple
of
minutes. All right, so let's go ahead. So I will hide Ida 1 second, and I will display my screen. All right, so I'm sharing my screen, and now I will go back over here and show it in the stream and show it properly here. All right, so now we're seeing UFile on the screen right now. So in order to enter your home office expenses, okay, whether it's the flat rate method or whether it's the detailed method, all right, what you do is that you go to your interview setup over here in the program. So interview setup, tick the box next to employment expenses. So in the employment and other benefits section, you tick the box next to employment expenses. Click next at the bottom of the screen, and then you're going to notice a new section that appears on your left-hand navigator, which is called employment expenses. Click on that. Click on employment expenses, and then you've got your options, your first three. So if you want the temporary flat rate method, you simply click on the first option here, which is the temporary flat rate method. You click on the plus sign right there. If you want the detailed method, if you're a salaried employee, most likely the majority of you who are watching this right now, you're going to be a salaried employee. Then you click on the plus sign next to salary. Okay, so next to the T77S, salary. So if I go with the flat rate method, click on the plus. confirm that you meet the basic criteria of the flat rate method, which is essentially you are required to work for more than 50% of the time for at least a month or 4 consecutive weeks at home due to COVID. Okay, as long as you meet that basic criteria, say yes and enter the number of days that you worked, that you're required to work from home. Remember that the flat rate method is a $2 flat rate deduction per workday. Your maximum deduction is $400. Okay, which means it's your maximum number of days that you can claim is 200 days. So that's how you claim that. So let me stop sharing. All right, and let's go back. Let's bring Ida back to the fold here. There you go, Ida, and now we're good. All right, I think we answered the question.
Now we have another question from Amanda Casey.
Okay, perfect.
Okay. I have a self-employed capital asset in Class 8 that was purchased for $2,000 in 2018. $200 was depreciated in 2018, but we chose not to depreciate anything in 2019. So on the books, we're still at $1,800. The asset was sold in 2020 for $1,600. I would like to depreciate $200 in 2020 to close off the asset to zero. But when I dispose of all assets in the class for $1,600, it only allows the depreciation of $40, which is 20% of the $200 left over. This results in an amount of $160 left in this asset class, even though I have selected that all assets in the class are disposed of. Additionally, when we entered the asset in 2018, we entered each asset separately, i.e., one entry for a camera to Class 8, one entry for a lens to Class 8, etc. Since we only have a few assets, this is seemingly easier to track the assets than lumping them in one line of Class 8, which I think is how the system wants it. Is that correct? Can you please talk about what the system and the CRA require when it comes to the T2125 and the related sheets?
Okay.
Wow,
so,
that's a long one.
Yeah. So first, I'm going to go through. I'm looking at it again. Of course, it's truncated on the screen because the screen doesn't have the space quite to be able to display it. But essentially, okay. First things first. A Class 8 you cannot have two distinct classes for a Class 8. Okay. The rule, as per the CRA, is that all assets that fall into Class 8 or the majority of the classes in the CCA classes, they have to be in one common class. Okay, that's number one. So these have to all be in one. Okay, so you have to be careful with that because the government can come back and if they do an audit, they will mention that to you. That's what the rule is. You can't have distinct classes for Class 8. So the two assets that you have are supposed to be in one class. Okay, that's number one. All right. Now let's assume that rule does not exist. Let's assume because right now you've done it the other way. Okay, so in this case, when you've disposed of that one class, you can't claim depreciation on the class you've disposed of. If you're liquidating that class, there's no longer anything to depreciate in it, with minor exceptions. One of them being vehicles that are worth over $30,000. Okay, so you cannot do it. Now, in this case, so you got 60. I don't know how you're getting that $200. To be honest with you, that 160 for that class. Went through each asset separately, one entry in Class 8. So basically what the program is taking the depreciation of the one Class 8 you did not dispose of. And it's not allowing you to depreciate the Class 8 that you did dispose of because again, you disposed of that asset. You cannot claim depreciation on the value of the assets that you disposed of. Okay, you simply can't. Okay, that's essentially what the rule is. So I'm hoping that answers the questions. I'm hoping that answers it.
Okay, the next one is Anna Howell. Hello, Anna. Okay, is there any possibility Jerry can make a video showing us where to enter different home expenses for employees working from home due to COVID? Maintenance and repairs for room only at 100% is not claimed 100% when entered in the maintenance box.
Yeah, I mean, we have a video right now on YouTube. We have a video on YouTube that shows that shows essentially how to get there, right? How what do you need to do to get to employment expenses? Yeah, that could be something that I could definitely, Anna, I could definitely add to the YouTube page. And by the way, for those of you who are not aware of it, we have a YouTube page. Okay, you just simply search up UFile, find the page, subscribe if you want to, and we add regular videos on tax topics. So we do like kind of like similar to what we're doing right now, but we discuss the specific tax topics. We do a podcast essentially. On YouTube in this case, and we do how-to videos on our YouTube page as well. So don't hesitate to go there and subscribe and like the videos, please. That would be awesome if I could get a few little thumbs up on the videos that we produced. But essentially, yeah, that could be a good idea if you want. Yeah, that could be something that we could add. I know that we had a suggestion on the French side to add something with caregivers. That's another one that's going to be in the book soon. So yes, I could certainly do a detail on the detailed method specifically.
Okay, just before we go to the next question, Doug, can you be a little bit more specific on your question? You're saying when the pandemic hit, you were a 50% part-time teacher on call, working full-time for 35 years. So I'm not quite sure what your question is, if you're implying the work from home or not. Okay, Edward Sands. Okay, he has an undivided co-ownership property in Montreal. He redid the roof. Can he claim the expense, and where do I enter the details?
Okay, so the roof is the government would consider that a capital expenditure. Okay, but again, this would have to be a rental property, by the way. Okay, this can't be your principal residence. Okay, for your principal residence, that doesn't count. If you're renting at least a portion of that property, if you're renting at least a portion of that property, then it is a capital expenditure, and you add it to the cost of the building. In other words, you have to go to the CCA class. You should have a class 1 already there for your property with a value of the building when you bought it. Okay, you're making an addition to the CCA class. Okay, that's essentially what you're doing, because the government would consider this a capital expenditure and not a current expenditure. Okay, but remember, it has to be a rental property. It is not deductible if it's your principal residence.
Okay, next question from Nancy Schneider. Yep. Okay, if you have past capital losses and now want to use it against current capital gains, where and how do you do that?
Okay, so you have to enter them in the software. So again, sorry, Ida, I'm gonna have to hide you there. So give me a second, everybody, and I'm gonna go ahead and share my screen and show you how to do that. All right, so share. Here we go. And show it in the stream, and let's show it properly over here. All right, so the way you would do that in the interview setup, okay, make sure, so again, the interview setup section on your left-hand navigator over here, that's where I'm at. Make sure you go to investment income over here, and you tick the box next to capital history, capital gains, and cap gain history. Make sure you tick that box right there. So you click next at the bottom of the screen. All right, once you've done there, you go into, now there's a new section that appears in your left-hand navigator, as you see where my cursor is right now, capital gains enable. You click on that, and of course, you simply go, you simply go into capital gains and capital gains deductions. Hold on. Let me just go. So first of all, your actual transaction would be entered in stocks, mutual funds, and other information right here. Okay, so you would simply click on that and simply input it in. All right, and your historical information. All right, let's go in here. Normally you would input this into, let me go here. No, that's capital loss of previous years used. Sorry, I'm not in the right section. So that would be to enter the transaction. So give me 1 second over here. So I will here we go. Sorry about that. So first things first, what I showed you now is to enter your current year transaction. Okay, so the capital gain that you're inputting. Now, your losses from prior years that have been carried forward from the previous year, you will go into the carry forward amounts and prior year information when you are in the interview setup right here. Tick on losses of prior years, carrybacks. Okay, so you simply tick that box there. Click next at the bottom of the page. Now you will notice a new section on your left-hand navigator, which will be losses of prior years and carrybacks. You simply click here. You've got now an option that says net capital losses of other years. It's right there. Click on the plus sign. So click on the plus sign right here next to net capital losses. And once you're there, you input the losses per year. Okay, so whenever that loss was incurred in the previous year, simply plug it in. Once that is plugged in, when you calculate the return, when you go to the review section or the tax return screen, UFile will apply the capital loss from the previous year automatically against the capital gain that you entered in the current year. All right, so I stopped sharing. Let's bring back Ida. There you go. So Ida's back. All right.
Okay, next question from Keith.
Okay.
My daughter works from home for a company based in Europe. She is not an actual employee, but is paid by the company as if she is a subcontractor.
Yeah.
2 questions. First, where does she apply her income? And second, are there tax advantages for her to becoming a business?
Okay, so now I think with the second question, you got the answer to the first. Okay, since she is a subcontractor, she's considered as self-employed. So you would enter it as a business. Okay, so in UFile, you would choose the business section, and you would enter it as a T2125, either as a professional or as a business, one or the other. It depends on what she's providing. It's likely a service, so therefore it's professional. In this case, you would input it there. The advantage of being self-employed is that, of course, number one, she can deduct expenses now. Okay, so for example, if she's got a home office, she could deduct expenses related to her home office, like rent, like heating, electricity, etc. Equipment that she buys. For example, if she needs to buy a new computer, that could be a capital expenditure that is deductible off of your business income. That's one advantage. The other advantage is the fact that she doesn't pay tax right away. Okay, she only pays tax on her tax return later on when she actually files. Okay, so that's a big advantage as well, because employees have to pay payroll taxes right away. They only see the net amount. Meanwhile, your daughter is collecting the gross amount of income, and she could take that money and do something with it. So we're talking, of course, the economic concept of opportunity cost, right? An employee doesn't have that money right away. Meanwhile, a self-employed person has it and can deploy it back into their business or invest it, do something with it, and they only have to pay tax as of April 30th of the following year. Okay, so that's another advantage of being self-employed as well. Okay, so these are some, of course, there's a bunch of them, but for time constraints, these would be some of them.
Okay, our next question is from Mary Snyder. Can you please explain the new electronic signature feature in the T183?
Okay, it's not really a feature. What the T183 is that if your customer is electronically signing their T183 form, so this you are, I'm assuming here you're a preparer in this case. You're using UFile Pro in this case. So the T183 in this case, what the requirement is that if your customer has electronically signed their T183 with you, okay, meaning that they've given you authorization to transmit their file using eFile, you have to tell the CRA the date and the time that your customer has signed. Okay, that's 183. And that's essentially what the software is asking you. It's not a feature, it's actually a requirement. Okay, they're essentially asking you, the government wants to know this information. By electronic signature, what the government understands as electronic signature is the customer hasn't physically signed with a pen and paper. They've used some sort of software, be it a secure signature like Docusign, for example, or be it through Adobe Acrobat, where they simply do, an electronic signature, but that's not secure. In other words, it's not password protected in this case. Okay, so in either case, your customers considered to have signed electronically their T183, and then you, as a preparer, you're required to specify to indicate this to the CRA. Okay, and you indicate the date and the time that the customer is signed.
Okay, Marcella Gomez.
Okay.
Where can I inform the income? Where can I put the income from a babysitting work?
Okay, so if you've worked as a babysitter, then you are likely self-employed. Okay, you're very likely self-employed, which means a business income. So in UFile, you would indicate it as self-employed income or business income, and you either choose professional or business, one or the other. Okay, that's what you would choose. All right. Now, It's possible. I'm assuming you didn't get a T4. In certain instances, there's some babysitters that are considered employees because the fact that their schedules are being mandated by the customer. But if you didn't receive a T4, then you're self-employed. Okay, that's essentially what it is. Business income.
Okay. Because she added that she worked the last 60 days of last year, so it still doesn't. It's still business income for her.
Yeah, it's still business income. Yeah,
Self-employed.
yeah, self-employed income. Yeah.
Okay, Dr. Hasmuk. Sorry if I didn't pronounce your name correctly.
Perfect.
Okay, what is the class for buildings with a cost exceeding 50,000? It should be entered in a separate class, not class one.
Yes. So a class, that's a class 3, what you're talking about there. And that's usually for businesses, not necessarily, it's not related for rentals. Okay. There's specific criteria to it. I don't remember them off the top of my head. But essentially, yeah, if they're bought after a certain date and they're at a cost of more than 50,000 and they're used usually for a business, if memory serves me, then in that case, they fall under class 3 instead of class 1. Yes, a building is an exclusion. When I mentioned class 8 before about that you cannot use a distinct class, there are exceptions to that rule. One of the exceptions is class 1 building and a class 3 building as well. Okay, these are distinct classes every single time. So, for example, if you have a class 1 rental CCA, then you have to produce a separate rental statement for each building. Okay, while a class 8, which is equipment, you're lumping everything together into one class.
Okay, next question was from Anna regarding that maintenance at home there. She wants to know, just to confirm that I have entered it correctly in UFile online, I entered maintenance and repairs in other expenses, so it could be claimed at 100%. Is this correct?
Okay, I would think it's part of the prorated expenses to me. I don't think these are maintenance and repairs would not necessarily be expenses that would be considered as 100%. You would have to be, unless you can attribute them to a dedicated area. So, for example, if in this case, the home office is in a dedicated room where the only thing you do is your home office in that room, then yes, you could put some of those repairs at 100%. But if it's in a common room, like I'll give you my example. I'm in my kitchen right now, as you can see the beautiful flower motif that my wife has put up there. I'm in my kitchen right now. That's called a common area. If I did renovations to my kitchen, I can't claim the full 100% because this is a common area. It's not purely used for my home office. Okay, but if your room is purely dedicated to your home office, then yes, you can leave it there. But if it's not, you would have to put it in the general expenditures.
Okay, next question from Farida. Okay, if I rented an apartment for myself, do I include the annual rent in tax return filing?
By myself, what do you mean? If I rent an apartment for myself, you have a business maybe? Is that what it is? And you're renting it as an individual? I'm not quite sure of the question.
Okay, we'll ask for a little bit more specific from Farida.
Yeah, Farida, can you just give a bit more details?
Okay, Frank.
Okay.
My wife and I are the primary caregivers for a 92-year-old father-in-law who lives in our home with us. What, if any, claims are available to us?
Caregiver. That's the Caregiver Mount is what's available to you. Very, very simple. Now, in this case, you're married, so you can't claim eligible dependent. In this case, and of course, you would need an infirmity. But remember that you need an infirmity. Okay, so you need a letter from a doctor that stipulates that your father-in-law, not that he's disabled, but that he's got difficulties physically and that needs your help. Okay, so as long as you have that criteria, then you could claim what's called the Caregiver Mount. Okay, so in UFile, you simply add your father as a dependent in your file, okay, and make sure you enter the age and make sure you indicate the infirmity that your father has. If he doesn't have a disability, that's okay, but if he's got an infirmity, then you have to indicate in the software, and then UFile will claim it automatically. So it's the Caregiver Amount that you can claim.
Okay, next question is Doug. I'm not sure really if it concerns taxes, but he feels that he is not entitled to the CERB because he has. Because I have a retirement benefit that I have paid into for 35 years. Okay. I did feel that I was entitled to employment insurance as I paid into the system. The money I was expecting from teacher on call was already spent and I needed the income. Should I just take the CERB or should he apply
I think you were
for
eligible,
EI?
Doug. I mean, I think you were eligible, Doug. From what I'm reading here, I mean, it looks like you were working on the side. You were doing part-time work as a teacher. So remember that the criteria to get CERB is that you needed a minimum. I think it was about $1,000 a month, either self-employed or employment income. So as long as you had that, you are entitled to CERB. So that's the key. So basically, you have to check. It's per week essentially is where you have to check. So you were collecting the CERB per week. Okay, so if for each one of those, I think it was $1,000 per month. Sorry, not per week, but per month. If you were collecting $1,000 per month employment or self-employment income, you were entitled to CERB. If you fell in a month where you were not collecting $1,000, then at that point, that's the month you're not entitled to CERB. But every month that you were working on the side, no, you're absolutely entitled. There was no other criteria. The government did not make the criteria very stringent to claim the CRB. So you should be fine. You should be fine in that case. But in any case, if you want to be safe, contact Service Canada and make sure that what I'm stipulating is correct.
Okay, thanks. Mary is asking, Mary Snyder. So
Okay.
Still with the T183. So do I have to have Docusign or some other application to use the T183 electronic signature?
No, you're not obliged to have DocuSign. I mean, a client could even use their browser or like Adobe Acrobat Reader. I know that, for example, I use Foxit myself, and they have an option for electronic signature. You could use any application that basically stamps an electronic signature on the form. The key to the T183 is that if your client has used that, and it's an if, you're not required, you're not obliged to do it. But if your client has done that, you have to tell the CRA, okay, that your client has done that. Okay, through the option in there of the T183.
Okay, back to the question of Farida. She rented an apartment for herself to stay in. She wants to know if she has to include the annual rent in her her tax filing.
It depends on the province that you live in. If you're in Ontario, then yes, you might be entitled to the Trillium benefit, which is part of the Trillium benefit, and then you would go into Ontario. You go to the Ontario tax and credits. You would go there and simply add your rent in there for the Trillium benefit. You might be eligible, you might not be eligible, but you could plug it in there. In the rest of Canada, I don't believe there are. I can't think of it off the top of my head. I know in Quebec, you would get a Releve 31. From your landlord, and you would be able to claim the solidarity tax credit. But Ontario is the Trillium benefit. Beyond that, I can't recall any other province that would have that. Maybe I'm wrong. I'm not sure, but off the top of my head, I can't recall anywhere else you would input it.
Okay, next question from Barzanit.
Okay, perfect.
Regarding CERB, I understand that there is a T4 which goes to income section. Is there any other section that I should be filled out for the CERB?
No. If you have a T4A with box, I think it's 197, if memory serves me. If you have a T4A with box 197, then you just plug it in there, and that's it. Then it gets declared on your tax return. It's taxable income on your tax return. It gets declared in the right line, which is other income, line 130, and that's it. There's nothing else really to stipulate. So as long as you got a T4, as long as you get the T4A, you just plug it in there.
Okay, Andrew wants to know how to complete the field in the RRSP filing, the form.
You mean a contribution? Is that the question?
I believe so. Andrew, can you just confirm that?
Yeah, Andrew, can you just add something to it? Yeah. Just to make sure.
Audrey, can you explain how to indicate a superficial loss on the UFile forms?
Oh wow, Audrey, you got that's a beauty. Superficial losses.
Don't you love those?
Yeah, those were when I was doing my master's. Those were the fun ones. Superficial loss. There's no special way of putting a superficial loss. A superficial loss, essentially, what it is, all you're doing, basically, you don't declare the loss and you add the loss to your adjusted cost base. That's essentially what you're doing. Okay, that's essentially all there is. So the government has not designed a specific form for superficial loss. Now, just to explain the concept to everybody, what is because right now probably everybody's looking at me cross-eyed, saying, "What the hell is a superficial loss?" Because it's a deep tax concept. A superficial loss, essentially, what it means is when you sell when you sell an asset at a loss, okay, for example, a stock. So I buy shares in a company on a public exchange, and I sell them at a loss, okay, or I sell them exactly for a loss. I have to wait 30 days before I repurchase that's those same shares in order for me to lock in my loss. So if I lost, for example, $2,000 in a stock transaction, in order for that $2,000 to be applicable on my tax return, I have to wait 30 days before I purchase that same stock. Okay, and that's even in the case where I purchase it. For example, if I had a non-registered account, which is where the loss would be, and then I purchase the same stock in a registered account, the same rule applies. I have to wait 30 days before I repurchase that same stock. If I don't wait the 30 days, then I have triggered the superficial loss rule, meaning the government simply refuses that $2,000. I'm not allowed to claim that $2,000 as a loss. So essentially, Audrey, what you do is that you keep it for your own records, okay? And what you're going to do with that loss is that you add it to your ACB, okay? You add it to your ACB for the new shares you bought in that same stock. That's all you do.
Okay, we go back to Andrew. Yes, he did do a contribution. He wants to know how to complete the form.
Okay, so it's very, very simple. So item behind you again.
Go
Sorry
ahead.
about that. Man, I'm so rude. It's incredible.
That's okay.
All right, so I'm hiding Ida right now. Let's go ahead and share my screen, and I will show you. It's very easily done in UFile. So I will share now. Give me 2 seconds. Show in my stream, and now I will show it properly. Here we go. So now, okay, so in every file that you create in UFile, UFile will always create this RRSP contributions and limits section in your navigator. Okay, so you don't even need to go to the interview setup like I was doing before when I was doing some other how-tos when I was answering questions. Okay, so in this case, you don't need to go to the interview setup. It is a default section that UFile adds. You go to RRSP contributions and limits. You click on that. So first things first, you need to input your RRSP deduction limit based on your notice of assessment. So you can get that on your notice of assessment, which is the result of your tax return from the previous year, or simply go to your My Account portal with a CRA. Okay, so go into, create the account. It's very easily done. It's child's play to create My Account with a CRA. Okay, and you can even use your bank credentials as your login. Okay, so whatever you log in with your online banking, you could use that as your credentials. Okay, so within your My Account portal, the government will stipulate to you what your limit is. Simply plug in your limit right there, and then plug in your contributions. You put in the issuer name, whatever your financial institution was, and plug in your contribution. It's as simple as that. Very easily done. So let's bring back Ida. All right, Ida's coming back in now. There we go. All right.
Okay, Audrey wants to know, how will the CRA know regarding the superficial loss?
Okay. So Audrey asked another question right after. Can you explain? Okay, let me see. I just wanted to display the question. All right, Audrey. Basically, if they do an audit, that's the only way they will know. That's the only way they will know. So listen, they have nothing prescribed for it. Okay, so the CRA has not designed a form to stipulate to them that a superficial loss was made. Okay, so all you do is, like I said, you add it to your ACB for the new shares that you bought. So you're adding it to your ACB, and at that point, if they come in check, you have your documents that prove. So basically, what's going to prove your superficial loss is that you need a document that shows when you sold and when you bought again, and it has to be within 30 days. Okay, and because that's what triggers the superficial loss, right? So that's essentially what you would do.
Okay, next question from Anna. Is box V on your Releve 1 included in employment income?
Yes, to my knowledge, this is for those of you who are not in Quebec. This is a Quebec question. So this is for the Releve 1. So for every T4 that everybody gets in Quebec, we also get an equivalent slip from Quebec, which is the Releve 1. And the Releve 1 box V, yes, would be included, would be added to your employment income into your box A. Okay, and that the slip itself will tell you that. If you look at the bottom of the slip, where it gives you the explanation of each box, it's going to stipulate that to you.
Okay, Venny has a question. I think it needs a little bit more clarification.
Okay.
What to do if attendant didn't pay rent during his epidemic? time that do I need to claim a loss on my income? Are you talking about rental income?
I'm assuming it's rental income. Well, you simply don't declare the income. It's as simple as that. I mean, if you never received the income in the year because your renter did not pay you for those months, you don't declare the income. Simple as that. You exclude it from your from your gross income. That's all.
And then whenever they'll pay, they'll tack on.
Well, it'll be next year. I mean, it'll obviously be for 2021 because that's when it was paid. So
Okay.
so you would declare it when it was received. That's all.
Mary is asking, all disposition of capital property are disclosed to the CRA. I think she's still talking about she's the one with the superficial loss.
No. That was Amy actually. No, that wasn't.
You see, you got a better memory than me.
It's the display of the questions. That's why. Now we finally display them, so it's great. Let me go back. Let me see if I can find Mary again. Unless Mary could just add a comment as to what the original question was.
Okay. Mariana, I'll get back to you through Messenger. I'll find you after and I'll send you a message. Okay. Lorraine.
All right.
Will there be a discussion regarding borrowing money for investment purchases, example, interest on a loan and or GST paid on a condo purchased for renting? Is this all with rental income when you declare your rental income?
Yes, it's so essentially that mortgage interest that you're paying in order to have rental income, that's in your rental statement. Okay, so you would declare it as an interest expense on your rental statement on the T776. That's essentially what it is, a deductible expense, because remember, the overarching rule of deductible expenses when it comes to income taxes is, did you incur the expense to make income? That's the first question you have to ask yourself. If the answer is yes, then it's very likely it's deductible, unless there's some specific rule that doesn't allow it. Okay, but that's the overarching, that's a specific limitation. That's the general limitation, as we call it, on expenses. Okay, so in this case, in your specific case, Lorraine, yes, you would declare it in the rental statement as an interest expense. That's what you would do.
Okay. Mary is saying, just saying, and then purchase date is also disclosed when repurchase same shares.
Yes, but Mary, how many capital transactions happen all year amongst Canadians in Canada? How many? I think it's practically in the millions, if not in the billions. Okay, a small transaction like that with one individual, the CRA is not necessarily going to notice. You understand? So the point of that is that the CRA is not going to notice every single little transaction. They would have to hire an enormous amount of staff in order to do that. The only way they do that is if they see something funny within the transactions, and usually these are bigger transactions that they'll notice these things, and then they audit. That's the only time they're going to notice something like that. So I mean, believe me, they don't have the staff to. I mean, just think of the volume of transactions. I mean, there's no way they could check every single one.
Okay. As we're waiting for other questions, you want to show them do you know how to complete the Trillium?
The Trillium, yeah, sure. Let me. Okay, I'm going to hide you again. Sorry,
Go
Ida.
ahead.
So let's go into the Trillium benefit, which was the question before. So let's go in there and give me 1 second. I will go back and I will show it in the stream and show it properly here. So let me just make this client a resident of Ontario in order to see the proper options. So I will click next. So once I'm in Ontario, I'm going to see a section called Ontario Tax and Credits. All right, so it's right there. So I click on there, and then you'll see right there the ON Ben, which is the Trillium benefit, essentially. Okay, so once I'm in Ontario Tax and Credits, which is the default section for any resident of Ontario, you simply click Ontario Tax and Credits, and there's a declaration of the rent paid, a property tax paid, or any other rent, et cetera, et cetera. Actually, the rent is for private long-term care home. There you go. Okay, so I was wrong on that. Sorry. So at that point, yeah, there's no other place really to enter rent that I could think of. I can't remember for any other, unless, no, hold on. It's the Trillium benefit. Here we go. Application for Ontario Energy. and etc. Okay, so you would basically apply there. Okay, so this would be the Ontario Trillium benefit right there. Okay, so let me stop sharing. Let me go back. Let's bring back Ida. And boom, there's Ida. All right.
Wow, magic.
You gotta love
Okay.
technology.
Lorraine has a question.
Sure.
If the condo is a new building purchased, is the
Mhm.
GST an expense for rental income, or do you cap it?
No, it would be a capital expenditure. Okay, so in other words, you're adding it to the cost of the building. Okay, you're adding it to the cost. Okay, so if I remember correctly, Lorraine, you're renting that condo. If memory serves me, you're renting that condo. So if you're renting it, you're adding it to the CCA class. So whatever your purchase cost, because that's something just to mention for everybody's benefit, is that when a purchase of a home is not subject to GST if it's an existing home. Okay, so if it's a home that's been built before, but if it's a home if it's a brand new home that was built in the year that you purchased, then sales taxes apply, okay, to those purchases. The sales tax is added to your capital expenditure, meaning your cost. So when you input your CCA class, which would be class 1, you're adding it to the cost of the building, and you're going to depreciate the GST expense with the rest of the cost of the building if you want to. Yeah, Lorraine confirmed actually that it was a rental. So there
Correct.
you go. Yeah. So you're adding it to the cost of the building. That's essentially what you're doing. And you could depreciate it afterwards at a 4% clip, at a 4% rate.
So if you have any questions, please put it in write it in the comment and be a little bit and give us as much detail as possible. For the working at home, for now employees that are working at home that we're allowed to claim our expenses, what cannot be included in the expenses?
Yeah, that's a good question. So for those who are going with a detailed method, right? If you're going to go with a detailed method in this case, then what is not eligible is, for example, capital expenditure. So you can't depreciate. Mortgage interest is not deductible either. Principal mortgage payments are not deductible either. Capital expenditures, like I said, so for example, replacing windows, big renovations are not allowed. We're not talking about maintenance, okay? Maintenance, painting, for example, that's allowed, but not like big changes to the home. Okay, office equipment is also not allowed. So you can't deduct the expense of a printer, of a computer, etc. Monthly basic rate for a landline, that's also not allowed. Cell phone connection or license fees, they're not allowed either. I'm reading it straight from the form, to be honest with you here. Computer accessories, monitor, mouse, keyboard, those aren't allowed. And furniture is not allowed either. So you bought a new desk, a new chair, those are not allowed, okay? And that's under what we call the detailed method, where you're actually deducting your actual expenses, your actual home office expenses. Okay, so they're not allowed. Okay, now if you go with a temporary flat rate method, then all you're claiming is $2 per day. You're not claiming your actual expenses. You're claiming essentially the flat rate that the CRA allows you to claim. Okay, the federal government allows you to claim, which is $2 per work day that you worked, up to a maximum of $400.
Okay, Anna has something similar. Question.
Okay.
In home office expenses of detailed methods of a salaried employee working from home due to COVID, there's a section other home expenses, brackets Quebec.
Yeah.
What expenses do I enter there? I thought UFile enters amount automatically to provincial boxes once you entered it in the federal box.
Yes, it does. This might be, for example, an expense that only applies to Quebec. It's rare. I don't think you're going to see anything really that's different between federal and Quebec. But any amount you enter into the general expenditures, UFile applies them to Quebec automatically. That's everywhere. That includes your income as well. So, for example, you have your T4 slip when you enter box 14, your employment income, it applies it automatically to the provincial return as well. So you don't have to worry about that. It's just if you have one of these exceptional cases, essentially.
Okay, next question from John. How can I apply for only a portion of last year's capital losses to be applied to this year's capital gain? I want to claim a part of this year's capital gain, but lower the amount with last year's deduction applied to this year.
Okay, so you only want to apply a portion of the capital. Oh no, that you cannot do.
He has capital losses. He wants to.
Yeah, that's it. No, that you cannot do. So how can I apply for a portion of last year's capital? Oh, I'm sorry. I thought it was this year's capital loss. I'm sorry. No, I misread that. So how to push a portion of last year's capital loss to be applied to this year's capital gain? Yeah, you can do that. I want to claim part of this, but lower the amount with last year's deduction applied to this year's. Yeah, you could do that. So if I go back, let me just go back and show you again on the screen. So sorry, Ida. I'm going to hide you again. Jeez, you're going to be so mad at me after this. It's incredible. So let's share the screen again. So I'm going to go here. All right, just give me a second, everybody. Show it in the stream and let's go there. All right, so let's go back here to the software. So where I was in the losses, here we go. Capital loss carry forward. So when you are in that section that I was showing before, okay, so again, interview setup. Okay, when you go to the interview setup, you go down to the section called carry forward amounts and prior year information. You got losses of prior years and carrybacks. You tick the box there, you click next. Okay, when you are in the capital, then you're going to see a new section on on your left-hand navigator called losses of prior years carrybacks. You click on the cap, and then you of course choose the option. You choose the option here, net cap losses of other years. Once you're in that section, simply scroll to the bottom, and then you tell the software what amount you want to claim. So the software by default is going to claim as much as there's capital gains. Okay, so it's going to try to wipe out the capital gains of the current year. If you want to limit that claim, then at the bottom of where the carry forward capital losses are, you have the option here. It says limit to the deductible capital losses applied in this year. You plug in the amount that you want to claim, and the program only claims that amount. So let me go back here, and here we go. All right, you're back, Ida. There you go.
Okay, let's take Jamina's question first, and then we'll go back to the other twos.
Perfect.
My father became a permanent resident a couple of years back. He is now planning to sell his home back in his country of origin to bring the money here to buy a home for himself.
Yeah.
What taxes might he incur?
Capital gains. I mean, he would have to declare a capital gain because now that home up until 2 years ago was likely his principal residence. So he can actually still claim principal residence and exempt the years that he was living there. Okay. But the 2 years that he's back here in Canada, those 2 years then would be taxable. Okay. So they would be a capital gain essentially. So you would declare, you would go into the capital gain section, go into real estate and go in there. And you would also designate principal residence because it was his principal residence. He's allowed to designate it. The only thing is for somebody who became a resident in the year, there might be some exceptional rules. You would have to read the section there. I can't remember offhand what those rules are. But at the base, you have a capital gain and you would be eligible. You might be eligible for the principal residence exemption.
Okay, now we're going to go back to Shadi and Farzanet regarding the home office expense, the fixed rate and the other and the detailed method. Can you just go over what's the difference? Because they seem to be a little bit mixed up, saying that you can't declare furniture in the detailed amount. What can they do? What are they admissible in the detailed amount? And what's the maximum of the flat rate?
Okay, so I mean, you know what? What's called up. So very simply put, you have two options when it comes to home office expenses. You can either go with a temporary flat rate method where you simply take $2 per work day that you were required to work from home due to COVID. You either take that one or you take the detailed method where you're deducting your actual expenditures. Okay. The expenses that you are allowed to claim are limited to very few amounts. Okay. Meaning for the detailed method, meaning rent that you paid, electricity and utilities, very basic maintenance. Okay. Pens, paper, stationaries, things like that. You are not allowed to deduct equipment. Okay, you're simply not allowed. And that the government stipulates it on the form itself. If you guys don't believe me, I'll show it to you on the screen. So let me do that 2 seconds. Sorry, Ida. So let me go here. And I'm going to go ahead and share the form itself. All right, so now over here, hold on. Showing stream. So now you're seeing me double, triple, and everything. Okay, and here we go. So now I'm seeing the form in front of me right now. So as you can see, I'm not making that up. So eligible expenses, they're right here. Okay, so you got rent paid, electricity, maintenance, like I mentioned before, home internet access fees, office supplies or stationary items. Okay, long distance calls. If you are a commission income employee, then you're entitled to property taxes, home insurance, and those things, but only if you're considered a commission income employee. However, under the non-eligible expenses, as you can see, furniture not allowed, computer accessories not allowed, office equipment not allowed. Okay, the government is very clear that you're not allowed to claim those expenses under the detailed method. I'm not the one making the rules. It's the federal government that makes the rules. Okay, so unfortunately, you cannot claim those amounts. Okay, so as you see there, and that's the direct form. That's the T777S. Okay, so that's the form that you will claim the expenses on. Okay, and that's directly from the CRA. All right, so let me go back. Okay, there you go. All right.
So
let's keep going.
The next question from Robert.
Okay.
What is the average capital gain percentage on a farmland sold after owning it for 28 years? You purchased at 150,000 and selling it for $1 million. It's my father's property. He is selling it now. He is retired.
Okay, so in that case, you would likely fall under the capital gains exemption. Okay, because farmland is exempted under the lifetime exemption. I believe the lifetime exemption for farmland is about at $1 million, just about. So in this case, it is likely that the gain would be exempt. Believe it or not, this sounds crazy, 150 to $1 million, and you're saying to yourself, "Wow!" But remember, somebody who's a farmer has invested a lot of capital and a lot of money to run that farm. Okay, and it's very likely that these farmers have not saved for their own retirement. They've not put money aside. They don't have a pension plan with an employer. You know what I mean? It doesn't work that way. They put all their funds into that farm, right? So that's why the government gives that kind of tax break, which is called the capital gains exemption, okay? Or capital gains deduction is a technical term. All right. So it is likely your dad would fall under that exemption, and it's very likely that the gain would be exempt. So in this case, you have an $850,000 capital gain. Normally, half of that would have to be declared as an income on the return. So it'd be what, $425,000 would be taxable income. Okay, which is a lot of money. It's a lot of money for 1 year. But remember that you do fall under the exemption, okay, because it's farmland. So it would be exempt. However, you might trigger what the government calls the alternative minimum tax, okay, which is a baseline tax that the government will impose for these kind of tax breaks, okay? But it wouldn't be a huge amount. It would not be a very big amount. It would be maybe 10% or 15% of that amount, okay? So that would be, if I were to just do a guesstimate without doing the return, because it's quite complex, a capital gains exemption. It's not an easy calculation by any stretch. I could get literally, it's a whole course onto it. We practically did a course when I did my master's. It was a whole course. So at that point, but remember that it does fall into the exemption. So 450,000 would be exempt, but you might trigger the alternative minimum tax. So you might have a 15% tax charged afterwards on it.
Okay, thanks, Jerry. That was interesting. Valerio, as a retired person on pension, I have a part-time online job as an independent worker.
Okay.
Okay, 1, can I deduct the cost of a computer I bought and use exclusively for my job?
Mm-hmm.
And 2, I declare this as self-employment business professional.
Yeah, I would say yes and yes. Okay, the answer. But remember that your computer would be a capital expenditure, not a current expenditure. So what you're doing is you're going to create it in a CCA class. You're going to have to put in a CCA class, and you'll be allowed to depreciate that computer over the years at a certain percentage of the value, okay, on a declining balance, okay? So if memory serves me, a computer would be a class 55. That's the specific class number you would have to choose to input your computer. And remember that the government also gives what's called the accelerated investment incentive, where you're tripling the depreciation rate for the first year, which is great. That was great news. That was the big change that was announced last year in 2019. So that's number one. That's for the computer. Yes, you can deduct, but you're depreciating your computer. You're not deducting the full expense right away. It's a capital expenditure, CCA class 55. For your second question, the income would be, you're very likely a professional unless you're selling goods. unless you're selling an actual product. If you're selling services, then you are a professional. Okay, and at that point, you're declaring within self-employment professional.
Okay, next question from Farhan.
Mm-hmm.
What if someone sold 50 different Canadian shares and 50 different US stocks?
Mm-hmm.
Do they need to show detailed transactions for capital gains, or can they enter it in one line for Canadian and one line for US
Yeah.
capital gains, and have the backup schedule in case the CRA asks in the future?
Okay, Farhan, the latter. When you're transmitting the return to the CRA does not see the detailed transactions. They don't see them. Okay, so if it's easier for you to enter, the cumulative for the Canadian and the cumulative for the US, do that, and then yes, keep a backup copy of the schedule in case you get an audit. Okay, so you do have to have a schedule if you're audited. Okay, but yes, no, don't input all 100 transactions in UFile. It doesn't make, there's no point, because the CRA will simply not see it. All they see is the total of the transactions. That's all they're going to see.
Okay, our next question is from Karen. What do they mean by marginal tax rates, and when should one claim them?
Okay, you're not claiming them, you're charged. That's one difference, because remember, it's a tax rate. Okay, so man, these are some really complex questions. I mean, superficial loss, farming sale, capital gains exemption, marginal tax rates. This is a great crowd. I love this. So essentially, a marginal tax rate. The concept of marginal tax rate is, what would you be taxed on the next dollar that you would gain? Okay, that's essentially what the marginal tax rate is. So let's say, for example, you're about to get a pay raise. Okay, how much would you be taxed on that extra income you would make? That's what your marginal tax rate is, and it's a good indicator, especially when it comes to RSP contributions, because essentially that's what you're determining. When you're contributing, you're lowering your tax, the income you're being taxed on. So the marginal tax rate tells you what you're saving when you're contributing to your RSP. So that's essentially, so we provide this as a service to all of you. We indicate that rate to you in order for you to have an idea of, for example, you get your pay raise, what would be the tax rate you would pay on that extra dollar you would gain. Okay, that's essentially what the marginal tax rate is. It's a more realistic figure of what you're actually paying tax-wise. Okay, what your tax rate is. It's a more realistic amount.
Okay, our next question comes from Mary.
Yeah.
In foreign property held in a registered account, like an RSP or TFSA, included in the $100,000 for the T1135 reporting, is it included?
No, it's not. No, you don't have to include it. It's only non-registered accounts that you would include in the foreign income verification statement, which is the T1135. And remember, it's cost, right? It's if at one point the cost of your properties was worth $100,000, and that includes cash, by the way. It's not just investment accounts.
Okay, Jack.
Okay.
I know there was a window update 2014 released on March 17. I am ready to net file, but I am not sure how long I should wait to see if there are any more updates. Will future updates affect what gets net filed, and how long should I wait to net file?
No, it will not. No, your future updates will not. We make little changes here and there, little improvements. Sometimes we just make little improvements to the software along the way. But as far as your tax return right now, no. Submit your return, get your money. No, don't wait around. Submit it.
Yeah, so that's it. Once the net file opens, our software is registered with the government, and you're fine to go ahead. Okay, exactly. Next question from Gaetan. I have paid to file my taxes. Okay, Gaetan, I'll get back to you for that, please. I'll write to you through a private message. Pat.
Oh, that's the one I had. Yeah.
Turned 65 in May, worked a little before the lockdown. UFile will not let me e-file because both fields must be filled. Regarding the CPP election to stop, I answered no to making the CPT 30.
Okay, so you're electing not to pay into the CPP any. That's for the rest of Canada. Quebec is completely different because it's the Quebec government that runs the program. UFile not let me e-file because both fields. You know what, that one I would have to see the file. Contact our support staff for that one. I don't know specifically why you're getting that message Contact them directly.
On the T4, isn't there supposed to, there's a little
No,
spot
it's
that
a
will
different
exempt?
section. No, it's a completely different
Okay.
section for the CPT 30. It's a completely different section. Barring seeing the file, it's hard for me to know. Why
Okay,
it's
Pat,
doing
I
that.
will write to you later.
Mhm.
Okay, John?
Mhm.
In a U.S. TFSA account holding U.S. stocks with dividends, how are the dividends treated by the CRA?
They're not. They're completely exempt. That's essentially what it is. So if you've got anything you have in the TFSA, the government does not touch, essentially. So whatever gains you make in that TFSA, they don't touch. And when you withdraw from that TFSA, they don't touch either because you're not declaring that income at all, okay, on your tax return. So you don't have to worry about that. The government, the CRA does not do anything, it does not treat in any way what's called those dividends. The only thing you have to be careful with is with U.S. stocks. That are held in a TFSA, you are subject to U.S. taxes on those U.S. stocks. Okay, but you are not. But there are no taxes withheld on U.S. stocks in an RRSP. Okay, so something to think about. If you want to be more efficient tax wise, if you can hold those dividends, if those U.S. dividends in an RSP instead of a TFSA, you will collect the full dividends in RSP. While in a TFSA, you will be charged a U.S. tax on those dividends in a TFSA.
Okay, next question from Trish. This one is a good one.
Okay.
Okay, it says on the UFile screen, net capital losses of other years, that you can see amounts for prior years on your 2019 NOA.
Yeah.
When I check my NOA, there's nothing listed. Does that mean I don't have one, or have they removed it from the NOA and it only shows now under the carryover amount section on my account?
Okay.
If I have one, does UFile automatically load any info for last year's carry forward amount from CRA if you do the autofill option, or do I have to enter it manually?
Okay, let me answer the last one first. It depends on whether the CRA provides that information, which I don't believe they do. They do provide, for example, your RSP limit and any installment payments you've paid in the autofill my return, but I don't believe they provide anything else on that. So that's not us. That's basically whatever the CRA decides to push to the software. That's not our doing. Net capital loss of other years. That my guess is that what you're mentioning is losses that you've claimed in the prior years. This is different from losses that you haven't used yet from the prior years. So if you look at the video earlier, I show everybody how to go into the losses section, to the carry forward sections. Okay, double check whether you're in the carry forward section or if you're in the historical section. Okay, where I was going before. If you're in the historical section where it's just indicating losses used, then that's different. That's the amounts that you actually claimed in the prior years. While if you are in the carry forward section, then if there's an amount in the carry forward section and your NOA doesn't have it, then it's the NOA that's basically the master form. You have to go with whatever the NOA is telling you. Okay, and the program will apply them automatically if it sees a capital gain. Okay, in your file.
Okay, our hour is up. We're going to stop taking questions and we'll go over what we have already in our queue. And the last person will be Gaetan.
Okay,
we will answer. Jeff, for detailed at-home expenses calculation, what is legitimate percentage of rent and utilities to claim for someone who worked at home at their kitchen table?
That it will be much lower than normal, right? I mean, listen, the technical calculation, the way you're supposed to do it, as per the CRA instruction, is you're going to take the square footage of your kitchen divided by the square footage of your entire home, and then that's your first percentage. Then you have to multiply on that percentage. You have to multiply the number of hours you work during a standard work week divided by the total number of hours during the week. So it'd be, let's say you work 40 hours a week, it would be 40 divided by 168. Whatever that percentage is, take that second percentage, multiply it by the first, and that is, in this case, that becomes, in this case, your percentage. Realistically, 3 to 5% is what the CRA would be expecting. Okay, roundabout. Okay, that's what they would be expecting in this case. But you could do the technical calculation as per what I mentioned. On our UFile blog, I give an example of it as well. So if you go to our website, which is ufile.ca, you go to let me see what the tab is again. I always forget what the tab name is. So when you go to tips and tools, when you hover your mouse over tips and tools, you have an option called the UFile blog. Okay, when you click there, we wrote an article on it where we even provide an example for a person who's working from their kitchen. Okay, we provide an actual example to show you how to do the calculation.
Okay, let's combine Cindy and Amin's question regarding T4s, regarding the T4 and T4A, how to find boxes in the software that are not showing up.
Okay. Well, that would be, on the T4A, that would be on box 28. So just remember that whenever, or additional information, I think is the or other information is the section. Just remember that anything in the T4A that you don't see a box number, go to box 28. That's where they all are. Okay. You simply click on the drop down menu and you simply go in there, choose the option and plug it in. Okay. So that's your best bet. Just go into box 28 whenever you have a box number on a T4A that you don't see displayed by UFile when you're in that area.
Okay, and Cindy, her question was the T4, the boxes 57, 58, 59, 60. Do you need to enter them? Yes or no?
No, you don't have to enter them. Okay, it's not required. It's simply additional information for the CRA that they already have. Okay, so essentially, what those boxes indicate to the CRA is that your employer applied for the wage subsidy. So a portion of your wage was subsidized by the federal government, and that simply stipulates what portions were. Okay, but as far as you on your tax return, no, you don't have to actually declare it on your tax return.
Okay, that would be the last question. Gaetan, you will need to send me a message on Messenger, please. That's not related. That's not a tax question related per se. So I'll take care of that for you. Your question.
Okay. So that's it. So I think we conclude here, huh?
Yes, we do.
All right. So yeah, go ahead. So I just wanted to mention, just remember, we have a lot of resources on our website. Go to ufile.ca. Don't hesitate to go there. Go again to the section called Tips and Tools. Okay, we have the UFile blog there. We have UFile Tax in You, where we answer specific questions that you have. So a lot of the questions that I've answered there, they're found in our website, which is again ufile.ca. Hover over the Tips and Tools tab, and then go to the Tax in You section. So simply go there. We also have a podcast through our YouTube page. We also provide a podcast where we discuss a lot of these topics, and we also have how-to videos on UFile as well on our YouTube page. So go ahead and go to our UFile page, subscribe. We post regularly podcasts and how-to videos on UFile on specific topics. I had a suggestion here today, which I will provide in a few days, hopefully. Once I get some time to be able to do it, I will be able to provide it directly there. We also have an audio podcast as well, which you can get through Apple Music, Google Podcasts, Stitcher, and SoundCloud. Okay, so we also provide there where we talk about different tax topics like some of the answers that I gave today. Don't hesitate to go there. We provide a lot of tools for you to help with your tax journey.
All right, so don't forget tax deadline, April 30th.
Yeah, April. Yes, you're right. I'm sorry, I got distracted there. So April 30th is your deadline. There is no extension. Okay, so please don't get charged penalties, even if you owe money to the CRA. Remember that for those of you who received COVID benefits and you owe money, to the CRA, you have till next year to pay that amount, and you have an interest holiday in this case. Okay, you have an interest holiday. You don't have to pay any interest on any amount owing as long as you received COVID benefits. Okay, so just remember that.
Okay, thank you for watching. You will be able to view this video after once we conclude here, and stay tuned. We'll probably have another Facebook Live before the end of the tax season. So thank you very much, Jerry. Thank you everybody for listening, and have a great rest of the day.
Yeah, have a great day. Stay safe, everybody. Take care.
All right.